There is no vault, no printing press, no mint, no paper, no metal. Over the past 5 episodes, we traced money from cowrie shells to fiat currency. 10,000 years of physical money. Now money sheds its last physical form. Only a network exists, invisible, intangible, spanning the entire planet. Every second, trillions of dollars move through this network, faster than thought, lighter than air. No human hand touches this money, no human eye sees it, yet it shapes every life on Earth. 97% of all money in existence today is digital, never printed, never coined. This transformation began in the mid-20th century. It exists as entries in electronic ledgers, ones and zeros stored on servers humming in climate-controlled rooms. This is where money lives now, not in vaults, not in wallets, in databases. And in 2008, the year the old financial system nearly collapsed, someone proposed something even more radical. What if money didn't need banks at all? What if money didn't need governments? The answer arrived in a 9-page document posted to an obscure mailing list. 9 pages, no institution behind it, no government backing, just mathematics and code, posted anonymously on a cryptography mailing list. Written by someone or some group calling themselves Satoshi Nakamoto. The Architecture of Value. Episode 6, The Digital Revolution from 1950 to the Present. The Digital Revolution. The story of digital money begins long before Bitcoin. It begins in the decades after the Second World War. It begins with a simple observation. Money had been becoming less physical for centuries. The telegraph, invented in the 1840s, first allowed banks to transfer money at the speed of electricity. A payment that once required a ship full of gold could now be completed in minutes. Western Union began offering money transfers by telegraph in 1871, the same decade the gold standard was born. By 1918, the Federal Reserve had built its own wire transfer system, FedWire. Banks could now move millions between themselves without a single physical coin changing hands. But for ordinary people, money remained stubbornly physical until the 1950s. In 1950, a New York businessman named Frank McNamara forgot his wallet at dinner. Rather than wash dishes, he had an idea that would change how the world pays for things. The Diners Club card, the world's first general-purpose charge card. A small piece of cardboard that told merchants, "This person is good for the money." It was, in essence, a portable letter of credit, a medieval concept reborn in plastic. Bank of America launched the Bank AmeriCard in 1958, later renamed Visa. MasterCharge followed in 1966, later renamed MasterCard. By the 1970s, millions of Americans were buying groceries, gasoline, and goods with plastic. The credit card did something profound. It separated the moment of purchase from the moment of payment. You could enjoy now and pay later. Consumption was liberated from the constraint of savings. This was exhilarating for consumers and enormously profitable for banks. Every swipe generated fees, every carried balance generated interest. The banks had found a perpetual revenue machine. But credit cards still depended on the existing banking system. They were not new money, just new plumbing. The truly revolutionary step required computers and the Internet. In the 1990s, as the Internet expanded, a new question emerged. Could money itself become digital? Not digital representations of bank money, but entirely new digital currency, native to the Internet. The idea was intoxicating, and dozens of brilliant people tried and failed. DigiCash, eGold, Beans, Flues, Liberty Reserve, each tried, each fell. The people who dreamed of digital money were not bankers, they were cryptographers. They called themselves Cypherpunks, a portmanteau of cipher and cyberpunk. Their founding belief was radical. Privacy is a fundamental human right, and cryptography is the tool to protect it. They saw the digital age approaching and recognized its dangers. Every electronic transaction left a trail. Every purchase created a record. Every payment was surveilled. Cash was anonymous, but digital payments were not. The cypherpunks wanted to fix this. In 1983, cryptographer David Chaum published a paper that electrified the community. He proposed blind signatures, a way to make digital transactions untraceable. Like a sealed envelope inside a carbon-lined envelope, the signer authenticates without seeing the contents. Chaum built DigiCash, the first serious attempt at private digital currency. It worked technically. Banks in several countries tested it, the technology was sound, but DigiCash failed commercially. Chaum was a brilliant cryptographer, but a poor businessman. The company went bankrupt in 1998, but the dream didn't die. It went underground, into the cypherpunk mailing lists. In 1997, Adam Back created Hashcash. In 1998, Wei Dai proposed B-Money and Nick Szabo designed BitGold. The insight was extraordinary. Make computers solve difficult mathematical puzzles to prove they had expended real energy. In 1998, Wei Dai proposed B-Money, a decentralized digital currency system. That same year, Nick Szabo designed BitGold, using proof of work to create digital scarcity. Each innovation solved a piece of the puzzle. None solved it completely. The pieces were all there: blind signatures, proof of work, decentralized consensus, digital scarcity. Someone just needed to assemble them. 10 years passed. Then, on October 31st, 2008, in the middle of the worst financial crisis since the 1930s, the final piece appeared. It arrived with exquisite timing in the middle of the worst financial crisis since the Great Depression. Banks were failing. Governments were bailing them out with taxpayer money. Trust in institutions was shattered. And onto a cryptography mailing list dropped a paper titled Bitcoin, a Peer-to-Peer Electronic Cash System. The author called himself Satoshi Nakamoto. No one knew who he was. No one knows to this day. The paper was elegant, 9 pages, no jargon, a complete blueprint for money without banks. Nakamoto's insight was built on all the cypherpunk innovations that came before. But he added one crucial element that made everything work: the blockchain. A blockchain is a ledger, a record of every transaction ever made, shared simultaneously by every participant. No single person controls it, no institution manages it, no government can shut it down. If one computer fails, thousands of copies survive. The ledger is virtually indestructible. To add a transaction to the blockchain, computers must solve a complex mathematical puzzle. This puzzle requires real electricity, real energy expenditure. This is called mining. The first miner to solve the puzzle earns the right to add a block of transactions and receives new bitcoins as reward. Only 21 million bitcoins will ever exist. This scarcity is written into the code itself, immutable and eternal. Unlike government currency, no one can print more. No central bank, no treasury secretary, no president. On January 3, 2009, Nakamoto mined the first Bitcoin, the Genesis block. Embedded in its code was a message: the Times 3 Jan 2009, Chancellor on brink of second bailout for banks. It was a declaration of intent. Bitcoin was born from fury at the failures of traditional finance. For the first year, Bitcoin was worthless, a curiosity traded between cryptographers for fun. In May 2010, a programmer named Laszlo Hanyecz made the first real-world Bitcoin purchase. He paid 10,000 Bitcoins for 2 pizzas. At today's prices, those pizzas cost hundreds of millions of dollars, the most expensive meal in human history. But in 2010, nobody cared. Bitcoin was a toy for technologists. Then the Silk Road happened. An anonymous online marketplace where drugs, weapons, and contraband could be purchased with Bitcoin. Bitcoin's anonymity, its greatest feature to cypherpunks, became its greatest liability in the public eye. Governments took notice, regulators worried, the mainstream media discovered Bitcoin and was horrified. But something else was happening beneath the scandal. Serious people were studying the technology. Not Bitcoin the currency, but blockchain the technology. The idea that you could create a tamper-proof decentralized record of anything, not just money, was revolutionary. Property records, medical histories, supply chains, voting systems, identity verification. Blockchain could potentially solve trust problems far beyond currency. Meanwhile, Bitcoin's price began its legendary volatile ascent. $1 in 2011, $1,000 in 2013, $20,000 in late 2017. Then crashes, brutal, terrifying crashes of 70 and 80%. And then recoveries, each peak higher than the last, each crash finding a higher floor. Believers called it digital gold, a store of value for the internet age. Critics called it a speculative bubble, tulip mania for the 21st century. The truth, as usual, is more complicated than either camp admits. Bitcoin solved a genuine problem: how to transfer value between strangers without a trusted intermediary. That problem, the same problem the Lydians solved with stamped coins 3,000 years ago, found a new solution. Not through royal guarantee, not through institutional promise, but through mathematics. The question is whether mathematics alone can sustain a monetary system. History suggests the answer is it depends on what you're asking money to do. Bitcoin opened a floodgate. Thousands of new cryptocurrencies followed. Ethereum, launched in 2015, added smart contracts, programs that execute automatically. Programs that execute automatically when conditions are met. No lawyers, no courts, no enforcement agencies. Money that could think, contracts that could act, finance without financiers. Decentralized finance DeFi reimagined every financial service without banks at the center. Lending without lenders, insurance without insurers, trading without brokers. By 2021, over $100 billion was locked in DeFi protocols. It was exhilarating, it was terrifying, and it was often spectacularly fraudulent. For every legitimate project, there were dozens of scams. Rug pulls, Ponzi schemes dressed in technological jargon, celebrity-endorsed tokens worth nothing. The crypto space replayed every financial scandal in history at 10 times the speed. John Law would have recognized the frenzy. The Mississippi bubble had found its digital twin. NFTs, non-fungible tokens, saw digital images sell for millions of dollars. A digital image of a rock sold for $1.3 million. Was this the future of art and ownership, or the purest distillation of speculative madness? The crash came, as crashes always do. In 2022, $2 trillion of crypto value evaporated. Terra Luna collapsed overnight, $40 billion gone in 72 hours. FTX, the second largest crypto exchange, was revealed as a fraud run by a disheveled 29-year-old. Billions in customer funds had been diverted to a hedge fund controlled by the founder. The parallels to traditional finance were painfully ironic. Crypto had been invented to escape the failures of banks. It ended up replicating them. Decentralization promised freedom from institutional corruption, but humans still ran the exchanges. And humans, as 5,000 years of monetary history teaches us, are reliably corruptible. Yet through every crash, every scandal, every wave of disillusionment, the underlying technology survived. Governments watched the crypto revolution with a mixture of fascination and alarm. Fascination because the technology was genuinely innovative. Alarm because it threatened their most fundamental power, the power to control money. If citizens could use Bitcoin, they could evade capital controls, sanctions, and taxation. China acted first in 2021, banning cryptocurrency entirely, then launching the digital yuan. Then it launched its own digital currency, the digital yuan, or EC. This was the opposite of Bitcoin in every way that mattered. Bitcoin was decentralized. The digital yuan was completely controlled by the People's Bank of China. Every digital yuan transaction created a complete record, visible to the state, a financial panopticon. Surveillance by design. The government could monitor every purchase, every transfer, every penny spent. The digital yuan could be programmed, money with an expiration date, money that can only buy certain things. Stimulus payments that must be spent within 30 days or they vanish. Currency that cannot be used to buy alcohol, tobacco, or anything the state disapproves of. This was programmable money, and it terrified civil liberties advocates worldwide. The European Central Bank began developing the digital euro. The Bank of England explored a digital pound, quickly nicknamed Britcoin. The Federal Reserve studied a digital dollar, cautiously, slowly, aware of the enormous implications. Every major central bank on Earth was now asking the same question. Should we build a government cryptocurrency? And if so, how do we prevent it from becoming a tool of tyranny? The democratic nations faced a genuine dilemma. Refuse to innovate and watch private cryptocurrencies erode your monetary sovereignty. Innovate too aggressively and create the most powerful surveillance tool ever conceived. Every purchase tracked, every donation recorded, every financial relationship transparent to the state. The Cypherpunks had warned about exactly this outcome 30 years earlier. Privacy in financial transactions, they argued, was not a luxury. It was a necessity for a free society. History showed what happened when governments could see every transaction. Between the wild volatility of Bitcoin and the surveillance risk of government digital currencies, a third path emerged. Stablecoins, digital tokens pegged to the value of traditional currencies, usually the US dollar. Tether, USD Coin, DAI, each promised to combine the speed of crypto with the stability of the dollar. Send dollars anywhere in the world in seconds, no bank needed, no wire transfer fees, no 3-day wait. For migrant workers sending money home, stable coins were a revelation. Traditional remittance services charged 7 to 10% fees. Stablecoins charged pennies. In developing nations with unstable currencies, dollar stablecoins became a lifeline. Argentines fleeing the peso's collapse, Nigerians hedging against naira devaluation, Turks protecting savings from the lira's freefall. But stablecoins carried their own risks. Tether, the largest stablecoin, was notoriously opaque about its reserves. Were there real dollars behind every digital dollar, or was this fractional reserve banking in disguise? The collapse of Terra Luna in 2022 proved that algorithmic stablecoins could fail catastrophically. $40 billion vanished because the mathematical model behind the stable peg turned out to be flawed. The ghost of John Law smiled. Paper promises, digital promises. The failure mode is always the same. Too many promises backed by too little substance. But the legitimate stablecoins survived, and their use continued to grow. By 2024, over $150 billion circulated as stablecoins, a new layer of finance. A new layer of the financial system was being built, neither fully traditional nor fully crypto. The architecture of value was being renovated from the inside out. And ordinary people, for the first time in history, had genuine alternatives to government money. Stand at the summit of 10,000 years and look forward. The architecture of value is being rebuilt in real time, and no one knows what the finished structure will look like. Will Bitcoin mature into digital gold, a reliable store of value for the internet age? Or will it remain a volatile speculative plaything, digital tulips for digital gamblers? Will government digital currencies become tools of financial inclusion, bringing banking to the unbanked? Or will they become instruments of unprecedented surveillance and control? Will stablecoins become the everyday money of global commerce, fast, cheap, borderless? Or will they be regulated out of existence by governments protecting their monetary monopoly? These questions cannot be answered today. They are being answered in real time by billions of human decisions. But history teaches us certain patterns that will almost certainly repeat. Innovators will build, speculators will frenzy, fraudsters will steal, regulators will regulate, bubbles will inflate and burst, trust will be built and broken. And through it all, the fundamental question will remain the same question it has always been. How do strangers trust each other? The Lydians answered with stamped gold around 630 BCE. The Chinese answered with standardized bronze. The Chinese answered with standardized bronze. The Romans answered with imperial silver and discovered that debasement destroys trust. The Spanish answered with mountains of silver after 1545. The Bank of England answered with paper promises from 1694. The Bank of England answered with paper promises and taught the world that institutions can replace metal. The gold standard answered with convertibility and proved that discipline enables prosperity. Bretton Woods answered with the dollar in 1944. Nixon answered with fiat in 1971. Nixon answered with fiat and wagered that belief alone could sustain a monetary system. And Satoshi Nakamoto answered with mathematics in 2009. Each answer was a revolution. Each revolution was partial. Each left the fundamental problem unsolved. Because trust is not a problem to be solved. It is a condition to be maintained. Like a garden, it must be tended every day. Neglect it and it withers, poison it and everything dies. The technology changes, the mathematics evolves, the institutions transform, but the human need remains constant, a way to cooperate with strangers across distance and time. Money, in all its forms from cowrie shells to cryptocurrency, is humanity's answer to that need. It is our most important invention, our most dangerous tool, our most revealing mirror. The Architecture of Value, Episode 6, The Digital Revolution. From Satoshi's white paper to central bank digital currencies. The newest chapter in the oldest story, 10,000 years and counting. The story of how we trust each other, the story of how we fail each other, the story of how we try again. This series is dedicated to every person who has ever held a coin, a note, or a phone, and trusted. Written and produced with extensive historical research and scholarly consultation. All visualizations are AI-generated historical reconstructions for educational purposes. Sources include scholarly works by Finn Brunton, Nathaniel Popper, Nick Carter, Saifuddin Amis, and Eswar Prasad. Thank you for watching The Architecture of Value. From cowrie shells in 8000 BCE to cryptocurrency in the 21st century, from village trust to global networks. The architecture endures, the value evolves, the trust continues. How money shaped our world. Thank you for joining this journey through the architecture of value. Further beyond,